The world we look at today won't be the same tomorrow, especially when it comes to your personal finance. Come tomorrow, the new rules of taxation and changes announced in the budget this year will come into force. The impact is going to stretch from your income tax and life insurance to leave encashment. We reached out to experts to understand the changes in the tax structure, which can help you adopt strategies to maximize portfolio growth.
I would say the most important change is that now the new income tax regime will be the default regime. What this means is that if you are salary, then perhaps your employer will most likely deduct TDS based on the default regime, unless you give a sort of a confirmation that you want to opt for the old tax regime. I think this is one of the most important things that taxpayers need to be careful of. The other, of course, is the new change around taxation of debt mutual funds.
The new income tax regime is going to be the default regime from FY24. However, you can continue to stick to the old tax regime. The new regime makes tax rebate limit to 7 lakh rupees. That means taxpayers under the new regime will pay tax on their incremental income above the 7 lakh rupees threshold. The idea is to incentivize the new tax regime, particularly for small taxpayers. But how should you choose the regime and what are the things you should gear up for?
Unless you have a home loan or you are staying on rent and claiming HRA also, it's likely that the new tax regime will be a better choice for you as an investor. Now, with that, new beneficial new tax regime does not allow deductions for any tax saving investments. So clearly, you know, that area of tax planning will recede to the background if people start opting for the new tax regime.
If you're someone who's in a high tax bracket, say upwards of maybe 3 to 5 crores, upwards of that, then definitely you benefit from being in the new tax regime because the tax rates are lower. If you're somebody who's in the vicinity of say 7.5 lakhs, then again new tax regime for you, because up to 7.5 lakhs you will not pay any tax because of the new tax rates, and also because of standard deduction being introduced in the new tax regime.
Another key change is the taxation of debt mutual funds and market linked debentures. Investments in these instruments were taxed as long-term capital gains if held for more than 3 years. From tomorrow, these will be taxed as short-term capital gains according to the taxpayer's income level. It will strip investors of the indexation benefits which made these instruments popular. So, how should investors go about it?
I think this was long overdue. Government was aware of the fact and government was seized of the fact that people were taking advantage of that lacuna or loophole, if I may call it as. A lot of HNIs were using that route earlier, and they were parking their money, in those debt mutual funds. They were getting two benefits predominantly. One is lowering the tax rate from 30 to 20%, and second benefit is, which was again a significant benefit, they would get benefit of inflation adjustment. Now most of the debt mutual fund schemes are gone now, and I would say there is no tax arbitrage left. So in terms of realignment of your portfolio, one is there is still very limited window of 2 days. If you want to lock in your debt mutual funds, lock in right now. And because this kicks in from April 1st, and all the past investment that you've done will continue to have the same treatment, so they are grandfathered.
Life insurance is also an essential part of the portfolio. The key change you are going to see here is the taxation on life insurance policy. The exemption limit from proceeds of premium payment has been reduced. From 1st April, only the proceeds from the annual premium payment of Rs 5 lakh will be exempted. If the premium exceeds Rs 5 lakh, it will be taxed. But why has this change been done, and what impact will it have?
So I believe government must have introduced in after having a good thought through process, because for the years and years the government has been motivating people to do life insurance, and now all of a sudden they are saying that any proceed from the insurance would be taxable above 5 lakhs. So obviously it is a deterrent. This may be the reason from now on the government might have done for a reason that going forward, even by introduction of a new income tax regime, government would like to discourage telling people that where they should invest. Rather, they want to give a blanket tax exemption by increasing the tax slabs.
As the new financial year begins, one should watch out for the tax slab he or she falls into, especially since the new regime is the default. Moreover, it is apparent that the government is incentivizing the new tax regime. With debt mutual funds de-incentivized, alternate investment funds may gain prominence.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.